Welcome to the program. Welcome, gentlemen.
Thank you.
And we live in interesting times, don't we? Last week we saw the ECB surprise the market by cutting interest rates when people didn't expect them to. This week there's more talk about the taper. So is it Europe going down the gurgler and the US is recovering, or vice versa? Janet Yellen's coming in. What's going on?
We do start to see those rates move. What has happened, I don't know if you had a look at the recent RBA chart pack released on November 6th, but it basically showed that EPS growth in Australia has done nothing for 4 years. So in aggregate, earnings for Australian companies have not grown. On the index level, it was about 70. For 4 years, it basically, analysts sort of trimmed their forecasts over the years, but it always came back to the line of 70, and it has done. Even in FY14, the forecast is for it to come back to 70. So earnings haven't gone anywhere. But what's happened is the yields have collapsed. People can't get any money in bank accounts, so they're being forced to chase assets, being forced to chase the share market, the property market. We're seeing the property market flying in Australia, and it's all because of, you've got to get a return somewhere. And as these interest rates start to move back up, your risk premiums collapse, right? So your PE ratios, which are basically expanded because earnings haven't, at some stage they have to contract.
Yes, certainly. You mentioned that property costs is going through the roof at the moment, which is obviously crushing the yields on rental returns at least anyway.
So all over we're seeing yield compression, and yields are getting very, very skinny compared to bond rates, which are improving. In Australia we have record stock market, it is a record. No, it's not a record.
No. US is
house prices are a record.
House price record.
So we've got all this confidence coming through with consumers who are now spending more. We're seeing that in all the retailers, Harvey Norman, JB Hi-Fi, Reject Shop, everyone's spending. House prices are going up, so at some point, and housing starts are improving as well. So we saw CSR and James Hardie last couple of days. Very, very good results on the back of housing starts and housing construction shifting into gear, which is what the Australian government has been trying to do with low interest rates. So I think with all these positive factors coming through, the next move is up. And once they start to move up, what's going to happen with the share market when your risk premiums have to adjust.
That's John from Sydney as well. John, are you there?
Yes, good evening, panel. I'm asking about Virgin Australia, and the question is, if the three major airline shareholders decide to take the company private, what do the minority shareholders get? What price do they get, and who decides what the price is, and can minority shareholders actually reject an offer?
That's a very good question, because I think, especially in the case of Virgin, you see the volatility in the chart just there.
Thank you.
There's a lot of uncertainty when it comes to determining what happens to the minority shareholders. Let's start with Russell on this one.
I actually heard today that Virgin is doing a $350 million capital raising. Is that correct?
I haven't heard that myself, but that could be the case.
Market cap $1 billion, $350 million capital raising.
Right.
That's a disaster for shareholders.
Sure.
Absolute disaster. But it's coming back.
Are they looking to take it private though? Is that what John was alluding to?
I'm not sure about the actual deal. I just saw that flash across my desk today. I've got a lot of things going on, so I didn't get time to read it. We don't invest in airlines for a few reasons that Roger and I have discussed over the years.
Take the Warren Buffett approach.
Yeah, correct. They don't make any money. They're capital intensive. They're not sort of things. But going back to the question, if the business was taken over, obviously a consortium who would be looking to take them out would offer a price for this business. And then it'd be up to the independent expert, so they would assess the offer, they would have a look at the company, and they would say yes or no. And based on that feedback, then that's how you would be represented in a bid.
Yeah, we've got Bernard on the line. Bernard, are you there?
Yes, thanks for taking my call. Mine's on CSR. I've been a holder for quite some time. I've seen their report out yesterday, which was definitely an improvement on what they've been doing. I just wonder what the panel's thoughts are going forward on CSR, and is it the stock that they would be either getting back into or maybe topping up on in the future, please?
Was being referred to by the caller, he was saying that they've produced a fairly good set of numbers this time around. And a lot of that has been because they had such a terrible time the last 5 years. The housing market's gone nowhere for them. The market for them has probably contracted, if anything. But what we're now seeing is signs of a stable market. So it's not getting worse, but it's up to us as investors and our guesses as investors whether or not the market's going to get better. So all the costs and the restructuring they're done. So that's largely the improvement in this result. There's a lot of abnormals that aren't in there that have been in the previous results. So very good jump in earnings and cash flow. So now it sort of becomes, do you think the housing recovery is here? If it is, you're seeing improvement in housing starts, and this is one of the best positioned companies for that play, a cyclical recovery, if you will. We're not in it. The balance sheet still doesn't look good enough for us, but I know a lot of fund managers that are playing the housing recovery through the likes of the CSR and James Hardie, who I don't know if you saw James Hardie, I was up 14% today.
That's right.
So
we got a big kick last week after Toll Brothers came out with a very positive statement or outlook for the US construction industry.
Yeah. So the US is recovering, Australia's potentially recovering as well, so it all looks good for the housing sector.
Now let's go to Bethany. Bethany, you there?
Yes, hello Mark. Can you hear me?
Yeah, I can hear you loud and clear. Fire away.
Just long-term investor, early retiree, so it's a super fund question.
Sure.
Got the normal fortress stocks, the banks and a good diverse, and a couple of tech stocks, etc. But I am a long-term holder of Wesfarmers, and I'm just wondering whether to take some profits, whether it's going off the ball, given that I've got a significant holding in Woolies as well. And just wondering whether to hang on or, get out and given that there are the occasional valuable opportunities, as Russell knows, through Scaffold that come up.
I think, a very strong theme that's been coming out of this year, last couple of weeks in AGM season has been very positive results from the builders, which we talked about CSR and James Hardie, but also the retailers. So your Myers, your David Jones, your Harvey Normans, your JB Hi-Fi's, not the reject shop yet, they haven't reported. Your Woolworths that had very good like-for-like sales. I don't think we've seen Wesfarmers yet, but all the retailers are doing very, very well. So I think it's very important to retain some exposure to the retail sector at the moment. It is one of those sectors that's doing very, very well, and we're confident that earnings are going to grow for this sector. But just looking on a comparative basis, Woolies and Wesfarmers, they're not too different, are they?
Yeah.
Supermarkets, insurance. Wesfarmers has a coal division, so it's a little bit more diversified. But I wouldn't argue that's better diversification, probably a case of de-Westification. Still a phrase from Peter Lynch there. But look, if I was going to reduce one, it would definitely be on the Wesfarmers side. Wesfarmers is trading about 20 times forward earnings versus Woolies, about 16, 17. So that's obviously the continued theme around the coals and the turnaround, and bringing that back to a higher level of profitability, which Richard Goyder, under his management and his stewardship, has done a very, very good job, I must admit. So, but I would certainly retain exposure to the retail sector as much as I could, because, like I said, it is a sector that's doing very well. But in terms of overall portfolio, you have to have a look what other sectors you've got and try to balance that.
Sure. Okay, let's go to Abe from Sydney. Abe, you're there?
Yes, thanks for taking my call. I'd
Long time no talk. Where have you been?
Leighton Holding, notwithstanding the damage to its reputation lately, the commitment of the Liberal government to building new infrastructure. In view of that, does the panel feel it's got an upside from here?
So obviously the fundamentals seem to stack up at the moment. But if this corruption scandal does spread, are they likely to face sort of sanctions or penalties, or is that going to impact on the company, do you think?
Oh, look, I don't know how deep the rabbit hole goes, but if they are found to be guilty, which I'm sure they will fight to the nth degree to say that they are guilty, I'm sure there will be some huge penalties issued by the government on them. But saying that, fundamentally, do look cheap. But 10 times PE ratio is telling me something, and I'm looking at the share price going back from 2010 to now, and it's been one way. I really worry about the contracting space at the moment. As you've seen, there's been a lot of research reports by the big boys, CSLAs, the Deutsches, the UBSs, showing the decline in capex by miners, by oil and gas in Australia, and that's where these guys are largely positioned. They do have infrastructure projects, of course, as well, but it's getting very competitive. It's getting very hard to secure work. All the mining service companies I've seen, or most of them in this AGM season, have all pointed to the second half being stronger, but no one can see where this work is going to come from for the second half to get that strength. So that 10 times PE ratio might be warranted in an environment where everyone's contracting. So they may still have the revenue, but the contracts are being won on thinner and thinner margins, so your profitability is falling, even though you've got the same churn through the business. So, but I just don't think this sector at the moment has bright prospects. There will be a point where the government does layer on a bit of investment and spend, but that's not where their entire book lies. So I don't think you look at Leighton's like that. It's a bit of a black box in terms of its earnings.
Okay.